Generating an income from investments in shares is an area in which investment trusts and investment companies excel. Here are the key terms you need to know. First of all, this approach is called equity income. Equity is another name for share. We're talking about investment trusts buying shares in companies that pay good dividends. There are other investments from which income can be generated, bonds and property, for example, but we're focusing on the income from shares. Essentially, equity income investment trusts collect dividends from the companies they invest in and distribute it to their shareholders via their own dividends. Equity income investment trusts are divided into different sectors. Some invest only in the UK, some overseas. Some aim to generate a high income and others will pay a lower income but will aim to grow your capital as well. This is stock market investing, so nothing is guaranteed. Your capital is at risk and dividends can be cut or scrapped if times are tough. Generally though, investment trusts have a good record in growing dividends over the years. This is because, unlike other types of investment fund, they don't have to pay out all of their investment income. In good years, they can put a bit aside and create a revenue reserve to top up the payouts in lean years. Investment trusts pay dividends at least twice a year, although a growing number pay them once a quarter and even monthly to make life easier for investors. You can get an idea of how much income an investment trust will pay by looking at its yield. The yield represents how much income you could get from buying the shares at their current price. Most investment trusts quote an historic yield based on the dividends paid in the past 12 months. For example, an investment trust pays 2 dividends in a year of 5p and 3p. That's a total of 8p per share. If its share price is 200 pence, the investment trust yields 4%, as 8p is 4% of 200p. High-yielding investment trusts can become very popular. Their share price can rise above the net asset value of the investments they hold. This is called a premium. If the premium becomes too large, there is a risk the share price could fall, exposing investors to a capital loss. Often in this situation, an investment trust will issue more shares to reduce their price. However, as a general rule, investors should avoid trusts on big premiums.